Hey everybody, how you doing? It's your buddy Uncle Bruce here from Stock Markets with Bruce. Welcome to my channel today. Today's date is Monday, February the 17th, 2025. It is President's Day in America. Markets are closed, and so I thought I would give you a little recap of kind of what's going on out there since it's a day off for many of you, and give you a little kind of heads up where we're at and kind of what you might want to expect. If you're a regular of mine, welcome to the show. Usually I'm live every day, 8 o'clock Eastern time for my Gold Bagel members only for about a half an hour. And then at 8:30 in the morning, Monday to Friday Eastern time, I go live to the world. And you can join me here for the 1 hour before we open the market and the first hour of trading. And you're welcome to join me live anytime, Monday to Friday when markets are open. So we'll see you tomorrow. Welcome to the program. What we do here is we talk about making money in the stock market, but not necessarily from buying and selling stock. We talk about making money in the market by becoming stock option writers. This channel is full of casinos. The members who join me here and hang out here all the time, they sell options first and buy them back later at much lower prices because options have a tendency to lose value as they age out. And if you want to learn all about that, you can head over to my website anytime you like, and you can join stockmarketswithbruce.ca. Head on over there and check my classes out. There are 18 classes available on how to become an option writer and take money from the options market. Right now, this market is hot and incredibly popular among new players and a lot of gamblers out there. All right, well, let's talk about what we have going on here in this market. President Trump took office about 4 weeks ago, and the markets have been, fluctuating, since and up and down. I popped up here. I'm going to pop up here a chart that if you take a look at the far right, you'll notice it's at the very bottom there. It says September, and then all the way to the left at the bottom it says February. So you can see how the markets have done now since just before the election, November. You can see how the election was called and it was held by noticing there was a dip. Where it just begins, the November month begins, and you can see the red line there going across the screen from left to right. That is the 50-day moving average, which sort of smooths out the performance of the market. And you can see how the market backed off almost to the 50-day moving average for a few days in early November. And immediately after the election was called and Trump had won the House, the Senate, and the White House, the markets reacted very positively for a good week or two, only to stumble in mid-November, run again to early December, and then we began to speculate about tariffs and a number of other issues, and the market began to sort of waver a little bit. The inauguration was held just after the beginning of 2025. The market hit a new all-time high late January. Then we've had a few falterings, and now we're back up almost at record highs again. Overall, the market is actually only up about 2% from this time frame when Trump got elected. The market had been higher, but it's only up about 2% at this time. Tariffs, inflation, China AI issues, and geopolitical problems are now weighing in, and this is challenging the market's faith that the right man is in the White House at this time. And things are just going to get better. The best, or I should say, the market, this is the second worst performance for the market in the first 4 weeks of a presidency, by the way. Only Obama's first 4 weeks were worse. However, the best S&P performance in any presidency was when Obama's first term ended, up 85%. Unbelievable. Here's a chart for 2020 to 21, 22, 23, 24, 25 to give you a little bit of history, last 3-4 years. This mostly covers the Biden presidency. And you can see at the very beginning on the far, far right, there was a dip, a recovery. That would have been COVID, and then a topping out of the market right at the end of 2021. 2022, not a good year. 2023 was a recovery year, and 24 to 25, very good. So overall, the Biden presidency was mediocre, good, little pullback, and then a strong surge at the end. Other charts to kind of give you some more history. This is the S&P 500 from 1995 right up to now. That is a lot to take in. So I thought I would break this chart down for you a little more and show you the dot-com bubble. You're hearing about this. Most of you are too young to know what the dot-com bubble, or you may not been alive. You may have been alive, but you weren't an adult. Perhaps if you're under 40, you were 15 years old or younger. If you were born at all. If you're 55 years old, 25 years ago, you were 30 when the market topped out in 2000, the dot-com bubble. Look at where it came from in 1995. That was wild. The market sure had a wild run at that point. It really took a major haircut. At that time, of course, we had stocks that were that really had no business being public companies. They had no income, no revenues. They had concepts, and the market was way ahead of itself about what the economy will become someday with e-commerce. This chart here is from 1995 to 2005 or so, 2004. And that shows you, again, the run-up of the dot-com bubble and the meltdown afterward. This chart here, from 01 until just a couple of years ago, 2013, I should say, this is covering, first of all, the 9/11 attacks, the backing off of the markets and all the uncertainty after that, then the recovery in 2002 to 3 to 4, then the topping out of the market in 07 and 08. That was the financial crisis. This was all blamed on the big banks and all of the reorganizations of mortgages, the bubble of real estate, certainly across the U.S. And look at the market fall off from 708 down to 2009. It was pretty bad. It required a lot of government intervention to stabilize the economy. So look at that 50-day moving average. You can see how the markets were way ahead of the moving average in 07, 08, and then look how below the market went. It just plummeted way faster than the moving average could go. Just devastating. Of course, there was a recovery, but it took until 2011 and 12, years and years of blood, sweat, and tears to come back. And then here again is a little bit of a condensed chart. This is 2010-11 to now, and I want you to look at that red line. And that's what I want to kind of pay attention to. The moving average, see it way behind the market almost all the time, except for 2020 and 2022. You see that. And now look at the moving average way behind the current state of the market, which brings me to the question whether you should be in stock at all. Should you be holding any securities right now with the markets at near all-time highs? So the S&P is within a couple of hundredths of a percentage point of hitting new all-time highs. It is true that corporate America did report better earnings, a 16.7% gain in earnings in the latest quarter, but stocks are priced at unbelievable amounts or PE multiples. The S&P, just to give you an idea here, is sitting at 22 PE multiple right now. The 10-year average is 19, so it is above average. But the all-time high was the dot-com bubble, 26 times earnings. And if you're a follower of the market and you're into certain stocks that you love, they're trading higher than 26 times earnings. They're trading at higher levels than the dot-com market of 2000. Now, you can trade at 26 times earnings, 30 times earnings, 50, 100. If the market believes that the company can say double their earnings next year because it's a growth company, then you can discount that and say, well, it's trading at 40 times earnings, but with double the earnings, it's only 20 times next year's earnings. And if the year after that, they're going to double again, well, it's trading at 10 times 2 years out earnings. This has been the philosophy and the thought of the markets for the last number of years. But sooner or later, companies don't double their earnings every year anymore. We'll have to see how this goes. In 2025, S&P companies have recorded a 16.7% jump in earnings, but consumer prices in January gained the most since August 2023. And this is the scary stat that analysts watch and go, oh, wait a minute, this is a year and a half. This is the biggest jump in wholesale and consumer prices in 18 months, not August 24, August 23, and that was a bad year for inflation. You got to watch for this. So which makes us ask, if interest rates are tied to inflation and inflation is not dropping and is now rising at rates we haven't seen in a year and a half, is it possible that interest rates may have to be lifted later this year if inflation continues to roll along? This is a problem. A couple of stocks making news, of course, NVIDIA, a lot of news. That stock dropped in January 17% in value. I think it was on January 27th when the Chinese AI thing blew up. It's come back to still only be down 2.6%. So NVIDIA has recovered quite a bit of its losses. Earnings come out in the next couple of weeks. We'll be following that, of course. The other stock we're watching is Supermicrocomputer. SMCI is the symbol. This stock gained 32% last week, 5 sessions. Palantir did a little better than that as well. These two stocks, they were beaten. One was beaten down, SMCI. Palantir is on a roll right now, but both are trading much higher now than they were. And in the case of Supermicro, they have not released their year-end financials that were due back in July. June 30th financials have to come out, and September 30th financials have to come out by the 25th of February. So they have 8 days to get those two out. They're convinced they're going to do it. They've got auditors in place. There are other auditors left. So I expect them to release financials. The question is, how will the street react to the fact that these delayed financials are finally out? And can you either trust them, like them, hate them, worry about them? And maybe the more important thing is, okay, you've released your financials for the year end, June 30. Now you've released your first quarter, September. You're going to release your December numbers probably in the next month or so. That's great. You're catching up. But actually what the street wants to know is, how does management feel about the business? What about orders going forward? Now, SMCI has been very upbeat, the management, in the last little while, saying, oh, our sales are rolling. We're going to hit new records. The AI thing is really helping us. So we'll follow that. Time will tell. The key here is, do you need to be a shareholder of these guys? Do you need to be a shareholder of any stock? Do you need to be a shareholder of the Magnificent Seven? Do you need to be a shareholder of Palantir, SMCI, the hot stocks of the market? Do you really need to be a shareholder of these companies to make money from these companies? After all, if you buy stock with your money, you're expecting in the long run the shares to go up in value to give you a positive return on your investment. That's the ultimate question, is should you do that, or should you take another strategy altogether? And that is, I'm not going to own any stock at all. I'm not going to sit on any stock, period. I'm going to go to Uncle Bruce's website right here, and I'm going to go to his class section right there. That's the tab up there. And when I get over there, I'm going to start taking his classes on how to become an option writer. And I'll start with number 1 and number 2, and I'll go down the list. I'll learn all about using poor man covered calls and stock option roll strategies. And I'm going to learn about this business, stink offer, stink bids, the psychology of the market, how to maximize profit from writing stock options, advanced poor man covered call strategies, how to use other people's money to profit in the market. Yeah, fixing option trades and adding cash with smart spreads, and how to maximize profits. This is where you have a fork in the road to decide your future as an investor. Are you going to gamble in the market and just hope and pray that you buy and hold for a long time will pay off? Or are we right now with all-time highs in the market, all-time highs, not like the last year or two, all-time record highs? Is this the wrong time to go long in stock? Is this the right time to actually just learn how to write options on shares without owning them and earning money on depreciating contracts instead? This is where you might want to hang out with us every day, Monday to Friday. Join our channel as a member. Gold Beagle members, of course, also join me Wednesday nights, prime time, 7 o'clock Eastern time for Primetime Live. Gold Beagle members only. Ask me anything you want about options. During the day, when the markets are open, the hour before the open and the first hour, folks are here talking to me about their option trades, what they're doing, what they're up to right now. What do I think? What should this be? What should that be? What's the best strategy to use? And a lot of my viewers have decided cash is king right now. I would rather be long cash and write options using my capital only rather than hold a stock and then write contracts. Now, for some of you who have retirement accounts in Canada, the US, and elsewhere, you can't do credit spreads or other trades that you have to do perhaps in a margin account. And so you are looking to do option work, option writing, but you're going to do it from the point of view where you own a stock and you're going to write call options, covered calls against shares. This is a very accepted strategy and conservative strategy that pension funds and hedge funds and mutual funds have been using for decades. And I encourage that as well. We do talk about that. If you are a long-term believer in any of the Magnificent Seven or Palantir or SMCI, whatever your stock, you can certainly write covered call contracts against these positions because your game plan is, I'm going to hold these shares for 10 years. I'm not going to sell my Apple shares no matter what, Bruce. I'm just going to write covered calls against them. We do that here as well. We talk about writing covered calls all the time. Become an option writer, become a casino, and offer options to the gamblers who are buying these contracts. There are contracts out there trading at ridiculous premiums with huge expensive values to them that are not justifiable. And at the end of the day, you have something called, what I like to call kryptonite, that destroys option gamblers. And that is, you own the clock. The clock is yours, and you set the time frame for how long your contracts are good for until they expire. And if you write them the way we talk about here all the time, you're probably writing out of the money contracts or contracts with so much time premium to them that just the shrinkage of time alone will make you a fortune. Anyway, join me whenever you like, Monday to Friday at 8 o'clock for Gold Beagle members, 8:30 for all the rest of you. And whenever you're ready to learn how to write stock options, head over here, stockmarketswithbruce.ca. Start with lesson number 1. Take all 18 lessons over the next month or 2 or 3. You can take them one at a time, watch them as many times as you like, and you can always ask me questions about the lessons. Monday to Friday, when the markets are open in the morning. Thank you for joining me today. Have a great rest of your day out there for President's Day. And we'll see you here tomorrow, Tuesday, February the 18th. And we'll see if we can get you making some more money in the market. Have a good one, everybody. Bye for now.